$27,000, moved quietly, not by millions or billions. From the second quarter of 2025 to January 2026, trillions with a T changed places. While every news story praised the Fed's soft landing, on repeat, CNBC said that inflation had been beaten and a recession had been dodged, while the financial world pretended that we had reached the highest level of stability, trust, and everything else. December 2025 was the month when that movement grew the most. The markets hit all-time highs in the same month. It wasn't an accident. That was capital spinning quietly while the crowd cheered for the team. Because this kind of quiet escape has been seen before, time and time again, with the same beat. 1928, a little over a year before the Great Depression. 2007, which was about 18 months before the global financial crisis went from being manageable to being disastrous. The same setup, a public party, and a secret move. Same lag. Insiders move first, news stories follow later. We're now in the 9th month of stage 3. This is what most people miss. The system doesn't just fall apart. It doesn't break because of bad luck or a black swan that no one could see. It always happens in the same 4 steps. And the math behind it is so clear that once you see it, you can't take it away. The mechanism stays the same, but the names, assets, and stories change. In stage 1, things build up. Banks and other institutions slowly add a lot of money to whatever is making money, growing, and seems impossible to stop. They don't just take part in the market, they make it, fund it, and grow it. During the 1920s, it was business progress and consumer credit. Mortgage-backed assets and real estate loans were big in the 2000s. It was industrial real estate, regional bank loans, and long-term treasuries at the start of the 2020s. Stage 1 ends when a lot of people are exposed, borrowing money is common, and the marginal user changes from institutions to the public. Stage 2 is having the most trust. At this point, everything looks great. With markets at all-time highs, the media is happy, economists are declaring win, and government officials are taking credit. People think the system has been perfected and that things will be different this time. The roaring 20s, the housing boom in the middle of the 2000s, and the rebound after the pandemic, during which inflation was beaten and recession was avoided. When optimism turns into agreement and danger seems pointless, stage 2 is over. Stage 3 is the silent exit. This is the most important stage because it separates people who understand the loop from those who get stuck in it. The public story stays positive, but establishment money moves quietly to safety, not all at once and not with talks. Technically, slowly, using tools that most people never see. They hedge their risks, shorten the length of their loans, increase their cash on hand, and cut their credit exposure. There is a huge movement, but you can't see it unless you know exactly where to look. In stage 4, it's clear that the fall has happened. Credit markets freeze, money stops flowing, people are forced to sell, defaults spread, and investments that seem safe drop in value. Overnight, the story goes from victory laps to emergency talks. The repositioning is already done by the time the media figures out what's going on. The institutions that quietly left have cash on hand and are ready to buy what other people have to sell. That's why the number is important. 2.7 trillion, which will be spread out among different types of assets over the next 9 months until January 2026. There is no chance for trillions to move. Someone is getting ready for what's next by moving trillions. If you want to see how this pattern ends, click subscribe. In the next few minutes, we'll show you what insiders have seen before, what the current signs mean, and what it means for people who have assets in a system that is already changing. Let's go back to the beginning of this trend. Early in 1928, the U.S. stock market is at all-time highs. The Dow is rocketing up. There is economic hope everywhere. Major papers are pushing the idea of long-term success. The business of America is business, said President Calvin Coolidge. And business is great. Almost everyone is buying stocks. Barbers giving tips on investments. The boys who shine shoes are talking about their resumes. The whole country was sure they had found the way to get rich forever. But from January to September 1928, when people put a lot of money into the market, the people who designed it were quietly lowering risk. People with a lot of power, money, and connections cut down on exposure before the crowd even felt a chill. Joseph P. Kennedy, the father of the future president, got out of the market and said the line that people still remember today. It's time to leave when the shoe shine boy starts giving stock tips. People inside saw the pattern. The people saw a chance. Mainstream journals didn't start with stories about insiders leaving. They took the lead with hope. Then there is the well-known language of high confidence, which is right near the top. In late 1929, economist Irving Fisher said that stocks seemed to have hit a level where they would stay, highest level of confidence. The Dow hits its highest point on September 3rd, 1929 at 381.17. Then stage 4 comes along. November 24th, Black Thursday, a sharp drop. On October 29th, also known as Black Tuesday, there was more fear. Brokerages going out of business, margin calls, and forced sales. The market is down a lot by the end of 1929. And by 1932, the Dow has dropped to about 41, which is almost 90% below its high point. Fortunes were lost, funds were wiped out, there were food lines, suicides, and the Great Depression. But most people don't learn this. The early adopters did more than just stay alive. After setting up and waiting, they bought the ruins. People with a lot of money who got out early had cash when everyone else was scared. They bought oil, banks, real estate, and well-known companies for a very small amount of what they were worth before. The Rockefeller Center was built during the Great Depression with money that had been saved up earlier. Institutions that were in charge of funding survived, grew, and consolidated. People who believed that the language would stay high plateau were wiped out. It was the early money that bought things that made the century. Same pattern, same hope, same quiet exits, and the same punishment for the last group to come. Let's go to the 2000s now. U.S. housing was at its highest point in the first quarter of 2006. Over 5 years, prices have gone up a lot. Subprime loans is on the rise. Anyone who can beat a heart can get a mortgage. Wall Street turned those mortgages into assets, cut them up into tranches, put them in CDOs, and sold them all over the world. Rating companies put an A on them as if they were the safest things in the world. After level 2, the system always looks like it can't be beat. But between 2006 and 2007, the biggest money started to move around. People were still happy, and the story stayed the same. One example that is often used is Goldman Sachs. In front of other people, their sales machine kept pushing structured goods. In private, their stance became more defensive. Banks quietly cut their risk. Risk managers cut the length of time. Hedges kept talking. It was not shown on CNBC as it did not have a catchy title. Later, it was buried in papers and notes, but you found it later. It was called risk management and portfolio optimization. The first crack was clear in the summer of 2007. Bear Stearns says that 2 trading funds that had something to do with subprime have failed. On TV, analysts say it's a one-off. Everything works fine. BNP Paribas stops payments from funds in August 2007 because they can't figure out how much the mortgage securities are worth. There is no way to know how much something is worth. The market sways and then settles down. It will be taken care of by the Fed. March 2008, the Federal Reserve doesn't think there will be a recession. People don't react. Then, on September 15th, 2008, Lehman Brothers files for bankruptcy. The waterfall starts. AIG needs help. Washington Mutual doesn't work. Markets lose a lot of money. Hard drops in housing. Unemployment goes up. It's easy to see stage 4. And by then, the moving has already been done. And those who saw it first, they didn't just make it through, they became well known. For years, Michael Burry took heat, but then he made a lot of money. Bets against subprime gave John Paulson one of the biggest profits in the history of Wall Street. The big banks that shifted early did better because they were able to buy what other banks had to sell. The same plan. The time it takes for the public to learn about a private movement is the same. Now use that structure for the present moment. From January 2025 to the beginning of 2026, the story gets tougher. A soft landing was made. We beat inflation, avoided a recession. The market goes up to new highs. The tone changes to one of victory. In other words, the Fed did something that couldn't have been done. The approach is praised by economists. The politicians take the credit. The people calms down. The claim is that $2.7 trillion was secretly moved out of the risky areas that will break when stage 4 comes along from the second quarter of 2025 to the beginning of January 2026. There is danger in commercial real estate, regional banks, and long-term bonds, not because banks are trying to get an extra 1% of return, but because they value liquidity, ability to survive, and choice. That's what that looks like in everyday language. In this story, JP Morgan Chase gets rid of about $840 billion worth of business real estate risk. The office, retail, and multifamily sectors lower the amount of money that regional banks have to lend by about 230 billion and move about 340 billion from 10-year treasuries to 90-day bills. That shows it. This isn't a yield play, it's a cash play. You can't get out of a 10-year loan. You get your money back quickly with a 90-day bill. The return of capital is more important than the return on capital in a credit event. Goldman Sachs gets rid of about $520 billion in long-term investments like company bonds, mortgage-linked products, emerging market debt, and anything else that holds back money for years. When you have cash on hand, it goes from being useless to a strategic tool. This is because you need cash to weather market volatility and buy when you have to sell. The story also says that their gold and commodity hedges go up, not because gold is exciting, but because it protects them against rising prices and general stress. In this story, Bank of America cuts its exposure to mortgage-backed securities by hundreds of billions of dollars, shrinks some of its business loan book, and aims for the shortest treasury duration profile ever, with maturities that roll off in 6 months or less. Once more, shorten the term, lower the credit risk, and increase liquidity. How does that happen without being heard? It's not made public. They don't deal with the news. Interest rate swaps, options, and hedges are some of the things they use. This makes the outside look harmless, even though the risk is being taken away from the inside. Over 4 quarters, they add up to 5% here and 7% there, so the government and the media can just say it's normal and move on. Their moves of assets are based on structures and internal allocations that sound more like accounting than a danger sign. And it's already done by the time it shows up in quarterly reports. That's the third stage. The story stays upbeat, but the money starts to defend itself. Now look at the parts of this stage 3 story that make it stand out. There is a growth wall in commercial real estate. A number that is often used is $2.1 trillion in business real estate loans that will mature between 2025 and 2027. You're trying to roll over debt at rates that are sometimes 2 or 3 times higher than the original loans. This includes office buildings, shopping malls, and apartment complexes that were financed when interest rates were low. That's not a small change. It changes whether or not a building can make money. Defaults don't have to be the same for everyone if enough properties can't refinance cleanly. They only need to group together enough to make credit tight and cause losses. Most of the time, regional banks fall first because they have less freedom than the biggest banks and are closer to local CRE books. Not all of them can leave quietly. They can't all hedge at the same time. When money runs out and trust drops, they are left holding the bag. And if you were in a bank during the stress in 2023, you know how quickly deposits can leave when the story starts to fall apart. The yield curve comes next. Long periods of time with the 2-year treasury above the 10-year treasury are a classic sign of stress because they show that money is tight and growth prospects are low. In the context of this story, the inversion has been going on for about 18 months. This isn't about how well it predicts, it's about how long inversions hurt the credit process. Banks take out short-term loans and long-term loans. When that spread changes, there is less of a reason to make new loans, banking standards get stricter, and the system gets weaker as it lasts. Also, you can keep an eye on where institutions hide. People often say that the overnight reverse repo facility is where big money parks its cash when it wants to be safest. The $1.2 trillion that are just sitting there are seen as a flashing sign in this story. Institutions are ready to take low returns to avoid risk, and capital is picking safety over growth. Then there's the math of the debt, rate of debt to GDP around 120%. The real interest rates are still negative because the public yields don't fully cover the cost increases that happen in the real world. People often say that about $5 trillion in business debt will need to be refinanced between 2025 and 2027, moving from low-interest financing to higher-interest financing. When bills jump too much, defaults gather. If a lot of people fail, lenders back off. Growth slows down when lenders pull back. This is how Stage 4 starts. It's not just one event, it's a chain reaction. Now divide the timeline into 4 parts. Stage 1, from 2021 to 2023, build up in a world with cheap money, boost, and lots of cash on hand. While the system was flooded with cash, banks and other institutions stocked up. Stage 2, highest level of security, 2023-2024. The markets rise, inflation starts to fall, and the story of a soft landing takes center stage. Stage 3, from 2025 to January 2026, there will be a silent exit. Gradual repositioning, a defensive stance, and a desire for liquidity. That's where we are. Stage 4, The fall is clear. It is not a secret. Now is the time when the public can't ignore what the expert is already set up for. For this pattern, some think the clear phase might appear in late 2026, maybe in Q3 or Q4, but it doesn't matter what date it is. The crowd always thinks stage 4 comes out of nowhere because they didn't see stage 3. Sometimes the stock chart is the first thing that changes hands. The pipes are broken, credit spreads are getting wider, delinquencies are going up, bank lending standards are getting stricter, business mortgage stress is showing up in failed refinancing, and places where liquidity used to feel deep are losing it. That's where the warning is, which is why the shifting takes place in the background before it makes the news. The same words are used over and over again. 1929, always high peak. 2007, the national home market can't crash. 2025, the Fed now has better tools. AI will make everything better. Debt doesn't matter. This time is different. The math doesn't care about the time period in which the stories take place. When the amount of debt goes up and the cost of borrowing goes up, cash flows get tight. When there is less money available, pressure is weak. When institutions cut loan terms and raise money, they make options available. They're getting ready to buy later. That doesn't mean that disaster will definitely happen on a certain date. It means that the way results are spread out changes. People who don't pay attention to the downside tail find out too late that it's getting bigger. That risk was never taken away. It took too long. In general, what does stage 4 look like? It starts with a sound that sounds closed off. One part of credit blows out, a part of real estate rolls over, and one group of defaults goes up and then spreads out. Lenders pull back. It becomes choosy for liquidity. Weak balance sheets are shown to be weak. There are forced buyers. When people are forced to sell, prices don't drop just because everyone thinks they should. They go down because someone has to sell right away at any price that's out there. That's why those who move quickly win. They do not have to guess the spark. For the spark to happen, they only need to be liquid. People who moved early in 1928 went on to buy homes in 1930 and 1932. People who hedged early in 2007 bought things in 2009. As of January 2026, 9 months have passed since the move. The window is still open, but it's ending. That means you have two choices. Option 1, trust the news, believe that the win is real, and think that stability will last forever. Option 2, know the trend, keep an eye on where the money is going, and position yourself like you know cycles exist. Don't worry about that. It doesn't mean there will always be cash. It means that you watch out for length, leverage, and downside risk, because things can change quickly, since it can. If you're thinking why this is important when markets are high, that's what stage 2 looks like. The party is an important part of the circle. The calm exit is a part of the wheel. Alarms are always heard last by the people, and the next 6 to 12 months don't need to be like the last 3 years. Not as long as this pattern works the same way it always has.